Morning, good afternoon. Welcome to today's webinar. I'm Andrew Musgraves, Product Manager for VanEck's Gold and Resource Equity related strategies. Got a full agenda here and want to leave plenty of time for all of the questions you guys have already submitted. Thank you so much for submitting those. So I'll keep my comments relatively brief. Few administrative items here, housekeeping. As with past webinars, we want to try and keep this more conversational. So really encourage you to enter your questions at any time in the window provided. And if we don't get to it now, we'll be sure to do so after the webinar. And we hope you stay on the entire time, but if you have to drop off, of course, a replay of this webinar is available shortly afterward. And you can also reach out to us for a copy of the presentation by emailing us at info@vaneck.com. So VanEck, who are we? A lot of returning clients, some new ones. So just wanted to kind of give you the brief background on our firm. We've been around for over 70 years, founded by John VanEck in 1955 with the belief that investors sort of deserve access to opportunities beyond the conventional. And really, we kind of continue operating in that spirit today, identifying trends early on and offering intelligently designed solutions for clients in the process. And perhaps equally importantly, really helping clients navigate markets and asset classes where we have that more established domain expertise in areas such as gold. So VanEck, of course, long history in gold, over a 50-year track record investing in gold miners with one of the first actively managed gold mining funds in the world, several of the first and largest gold mining ETFs globally, as well as the several physical gold ETFs. And we're managing today somewhere around 40 billion in gold related assets, serving multiple markets across the globe. And all of this, of course, wouldn't be possible without some of the firm's investment expertise, including investment team members with prior career experience as engineers and geologists, quantitative analysts with experience in analyzing current historical gold price trends and asset allocation, and of course a team of client service specialists that are covering a vast majority of the retail and institutional market needs with respects to gold. So we're delighted to be hosted by some of these experts today. Ima Casanova, portfolio manager for VanEck's actively managed gold strategies, Joe Foster, gold strategist, as well as senior gold analyst Adam Graff. So I'll let Ima take the reins from here as we talk about, why gold is at record highs today, why it's not too late to allocate to gold and gold equities, and of course jump in to answer some of those questions that you guys have already offered up. So Ima, without further ado.
Thank you so much, Andrew, and thank you everybody for joining us today. We're going to keep our initial remarks brief, moving things along quickly so that we have plenty of time for questions at the end. We want to focus on what we know is investors' mind. 2025 was a phenomenal year for the gold asset class, both for gold and gold equities. And what you want to know and what everybody wants to know is what's going to happen in 2026. What are our expectations? What's our outlook for this asset class? So we're going to jump right into it. The next slide shows just how strong gold's performance was in 2025, the best year since 1979. We had to go back that far to see a year that was better than 2025. And Joe today is going to cover for us what's brought gold to these levels and what do we expect to see in 2026? What are the drivers behind it? And then we're going to move right on to what was an even more spectacular performance, which is the performance of the gold equities. The next slide shows there how gold stocks perform in 2025. They stole the spotlight. And again, we're going to try to focus on the things that we think investors are most focused on. And for the miners, as positive as we are on gold as the metal, we're much more constructive on the gold equities. And a lot of what investors want to know is what's happening with margins. The main concern tends to be what's happening with costs. Yes, the gold price is strong and it's increasing. What's happening to the cost side? We're really going to dial in today to why we think those costs are contained and margins are protected and providing a lot of support for gold miners in this environment. So with that, I'm going to let Joe go right into our gold outlook, and then he'll pass it on, and we'll continue with the gold equities. Go ahead, Joe.
Thank you, Emma. Hello, everybody. Just talking about what's driving gold and where we think it might go from here. This is a gold chart that goes back to 2015. It just shows the gold price. And you can see this has been just an incredible, extraordinary gold market. It's different this time. I know that's a cliche that nobody believes, but it really is different this time for gold. There's two reasons that this bull market is different from things that we've seen in the past. First of all, it's not driven by a crisis, not driven by an oil crisis, a stock market crash, a debt crisis, financial crisis, pandemic. None of that is happening, yet gold keeps going higher and higher. So that's very important point to make, number one. Secondly, the biggest underlying driver of this market is central banks, central bank buying. There's other things we'll talk about, but it really comes down to central banks that really kick this thing off. So if we go to the next slide and talk about what's been driving that, here's a chart of central bank gold buying over the last 20 or so years. And you can see central banks started buying after the financial crisis in 2008, and then their buying increased after the invasion of Ukraine in 2022. So just a tremendous amount of buying from central banks that are underpinning the gold price. And the reason they're buying is what we call in the markets de-dollarization or the debasement trade. They're trying to get away from the U.S. dollar. I mean, a lot of countries have lost confidence in the U.S. dollar. They're reducing their exposure. They're selling the treasuries to buy gold. So so that's one area. There's two areas where central banks are accumulating gold. One is part of their foreign exchange reserves. The other is to participate in a gold-based trading system that China is sponsoring. This is unofficially being called the Gold Corridor. China is building huge vaults in Hong Kong. We're seeing vaults also built in Singapore, Saudi Arabia, and other countries around the world to start a trading system that is based on gold. This system, again, it's called the Gold Corridor unofficially, and it's based 40% of its trading base is going to be gold. They're just kicking this off. There's 10 countries involved, potential for 23 more countries to come into this trading system. And we expect them to start a pilot program this year, and we'll see how this goes. But that's the other source of why these countries and central banks are accumulating gold. First, for their Forex reserves, and secondly, to participate in this gold corridor. And we can see this continuing for at least 2 more years. And we just saw yesterday where Poland has increased the ceiling on their gold purchases by 150 tons. So, central banks are continuing to buy. That last bar on the far right-hand side, that's through the third quarter. So that bar will be much higher when we get our fourth quarter numbers in, and it will be maybe not to 1,000 tons like we saw in the past 3 years, but certainly in the 700 to 800 ton range, which is tremendous demand out of these central banks. The next slide shows the other driver of this bull market. What we're looking at here is the gray line is just the gold price. The dark blue line is the total gold within bullion ETFs globally. You can see the peak on that chart in 22. There was a peak in the pandemic, and we saw redemptions out of these bullion ETFs following the pandemic. Far right-hand side of the chart, you see inflows into these bullion ETFs that started about a year ago. And that's the other big driver of demand is investment demand, especially from Western investors, but also China and India have ETFs that aren't included in this chart, and we're seeing big inflows into those bullion ETFs as well. So investment demand has become a big driver as well, on top of that central bank demand. why are investors investing in gold? Well, they're worried about what's, we haven't seen a crisis, but that doesn't mean we're not going to have one in this cycle. And everybody's worried about all the things we're reading about, the headlines, the geopolitical risks, the financial risks, the high levels of debt around the world, sovereign debt. All these things could precipitate a crisis at some time, and that's what have investors worried. In addition, we've got a new generation coming into gold. You look at Tether, they've got a gold-based stable coin. Tether is buying as much gold as the top central banks are buying right now. So this I guess call it a new generation of investors coming into the gold market, and it's another source of demand. So we see this continuing. Like I said, central bank buying could continue for at least a couple more years. The risks around the world just keep getting worse. Everybody, the potential for a crisis is there. So even though we're at near $5,000 an ounce, we think the trend is higher. We could get some consolidation here. We'll see. I mean, I was telling people last year, I think we'll test 5,000 gold and $100 silver. I didn't think it would be in January, but here we are. We blew through 3,000. We blew through 4,000. We'll see if we blow through 5,000, but it wouldn't surprise me to see some consolidation here, some sideways price action for a while, just to sort of catch our breath. But we'll watch it and see where it goes. And again, we think the long-term trend is up. So with that, I'll turn it back to Ema and move on.
Thank you, Joe. Yes, we woke up to almost $4,900 gold today. And as you heard from Joe, we are very constructive on the path of the gold price. From here, 5,000 is obviously just $100 per ounce away. So it's easy for us to talk about $5,000 gold in 2026. And with the obviously recognition that we might have some sort of pullback where prices settle at a little bit lower than that for some time before the next catalyst emerges that could drive it higher. And so you heard how positive we are in the gold price. I want to touch on the gold miners here with this slide, and I try to sort of lay out the cases. Clearly, and especially if you look at 2025, a higher gold price is very bullish gold miners. If we have in a rising gold price environment, we expect gold equities to outperform. And that's our first case here in this table. A rising gold price environment means the margins of these companies expand at a much higher proportion than the gold price increase, and that translates in outperformance for the equity. And we think that's what's likely to happen in 2026, given our views on the gold price. But what I really want to stress here is that even in that scenario, or during those periods that we might have a range-bound price action, or even a potential pullback in the gold price, these equities are positioned very well to weather that kind of environment. Let's say gold does trade range bound at this levels. We think the market is going to start to see this sustained gold prices and realize that these prices are here to stay, and start to price that into the equity. So even in an environment where gold is range bound, we could see outperformance from the gold equities because valuations might adjust to a higher price. And even during a pullback, we mentioned here gold declines but remains above implied $3,400 per ounce. That $3,400 per ounce might be a little bit higher today. We derive that by basically plugging in the gold price that would be required in our internal models to bring the stock price to match our valuation. And we did this based on, I call it $4,300 price, and it came out around $3,400, which implies the market's still factoring in a gold price that is much below spot prices. And so even in an environment where gold pulls back to 4,000 or 3,800 or somewhere below that, there is opportunities for these stocks to remain resilient and to have good performance based on the fact that their margins will still be there and cash flows will be protected. So we see an environment for the gold miners that looks very constructive, whether we have a higher gold price or a sustained gold prices from here. I will say that historically, lower gold prices have translated into underperformance of the gold equities relative to gold. But we are in a very unique environment where these companies are financially and operationally very robust and displaying and demonstrating very strong capital discipline. And we think that it could be that inflection point where the stocks manage to post good performance even in a subdued gold price environment. I'm not going to pass it on. I'm going to move to the next slide just to show where a lot of that strength and that resilience that we're talking about. And it's clear when you look at the next slide that shows where these margins are on a historical basis. This is obviously, this green line would need to go another $1,000 higher from here, which just makes my point even more clear, but all to show that these margins are at record, not only are at record levels, but are levels that, again, provide a lot of cushion for the gold equities. And so we're showing here average cost of production, all-in sustaining costs, the preferred industry metric, at around $1,600, $1,615 in 2025. What's happening in 2026? What are costs doing and what's happening to these margins? I'm going to pass it on to Adam to discuss this and our look for the miners in this year.
Thanks, Ema. If we could just go back to the previous slide. Thanks. Just to make a quick point here and reiterate something that Ema said, current gold and silver prices, miners are enjoying their widest margins ever on an absolute basis for sure. And industry average margin percents, maybe more important, are also at an all-time high. You have to go back to in recent history anyway, you have to go back to industry margins realized in the early 1980s to see anything like what we saw just last year, even before the advance that we've seen in January. Next slide, please. Here you see the 2025 all-in sustaining cost curve for the gold industry, and that it is sitting entirely well below. Well, forget about the spot gold price; it's sitting below $4,000 gold. And this gold all-in sustaining cost curve is from the World Gold Council. So it is neutral. It's not ours. It is produced by a third party that produces most of the data for that's accepted for the industry. The whole industry obviously is profitable by this measure. In my experience, even those mines at the very far right end of the cost curve are only there on a temporary basis as they're ramping up production in their first year, or they have a high strip year. So it's even on the very right side, those mines at the very highest cost, that's usually just a sort of a 1-year effect. Next slide, please. So here's the meat of it. We do expect moderately higher industry costs in 26, despite industry efforts to maintain or reduce operating costs. Some cost inflation is unavoidable and due either directly or indirectly to higher precious metal prices. The industry appears to be using a $4,000 gold for their 26 budgets. And so higher prices will drive higher royalty costs, higher mining taxes, and higher profit sharing. We believe, driving the industry overall about 5% higher costs on a year-over-year basis, just from the impact of $4,000 gold on industry costs. An example of this, an extreme example of this, is Turkey. The Turkish government has an 11.25% net smelter royalty on gold. So when gold moves from $2,000 to $4,000, that's another $225 per ounce of costs if you've got a mine that's producing in Turkey. Also, I'd note that both Ghana and Cote d'Ivoire are both raising their royalty rates on gold. So these are things that are outside the control of the miners and are naturally occur with where higher metal prices lead to higher costs. We're forecasting outside of the direct impacts on costs from higher prices. We're forecasting industry inflation outside of that, in part due to tight skilled labor markets as well as other macro factors. We see industry inflation driving another 3 to 5% for cost inflation. But importantly, the very wide margins that the industry is currently seeing and strong free cash flow generation is driving capital projects, stretching already structurally tight skilled labor markets in mining. And while a potential weaker dollar with lower interest rates is good for gold, it also would increase operating costs for non-U.S. operations in U.S. dollar terms. So overall, with the direct and the indirect impacts of pricing on costs, we're expecting roughly a 10% year-over-year cost inflation. But given the wide margins, we believe that the industry is well positioned to absorb this very moderate cost inflation. And record cash flows will continue to be enjoyed by the industry, and management will be focused on a capital allocation as far as how they're going to give back to shareholders or allocate cash between dividends, buybacks, balance sheet, continued balance sheet strength, and capital investment. I'll turn it back to Emma after that.
Thank you, Adam. Yeah, and I think it's important to, and we can go to the next slide, Andrew, because it kind of wraps things up here before we go to Q&A on just how attractive these miners look for the reasons Adam outlined. Yes, cost might be, going up a bit, but honestly, just the $300, $400 per ounce increase that we've had so far this year more than offsets those expected cost increases. So fundamentally, because of all the other things that Adam also mentioned as far as what the miners are doing, they're doing the things they can do to control costs. They're focusing cost initiatives. They're managing budgets at a reasonable gold price. They're not processing low grade that could bring unit costs up. And what's outside of their control, the impact of the higher gold price, again, more than offset by the gold price itself. So overall, we're seeing a sector that, like we said, I think over the decades that this team has covered, this sector is in the best shape it's ever been. And yet, look at where valuations are relative to gold. The equities still show very attractive valuations, which is why as we enter 2026, we think as investors turn to gold and look to add gold to the portfolios, they shouldn't only consider the metal, but also give some serious consideration to the gold miners. So we're going to stop there. We've talked enough, and just make sure that we open it up to questions now, Andrew.
Thanks, Emma and Joe and Adam. Really appreciate you guys hopping on and giving us some insights, some prepared slides there. Of course, this is what we like the most about these webinars is being able to answer some of the questions that you guys have. And we've certainly received quite a few in advance here and already have a couple queued up from participants this morning. So I guess just kind of following the way that you outlined this presentation, maybe we can start with some of the macro questions that we have, move into some of the gold and silver price outlook stuff, and then sort of wrap up with the miners. So I'll start with a few questions we had here about the Fed and rates. So how are we thinking about the Fed? What would a change in the Fed leadership look like in terms of gold price direction? How are you guys thinking about that over the next 12 to 24 months?
I'll let Joe also pitch in here, but to me, clearly all this uncertainty that we're seeing, all this potential threatening of Fed independence will continue to support gold. That's what's been happening this year, and I think that will continue to support gold going forward until we have more certainty. And clearly, lower rates. If markets are expecting lower rates to come out of the Fed, that will also continue to support gold. Lower rates historically have been positive for gold. Joe, do you want to add anything to that on the Fed?
Yeah, well, part of the Fed leadership change is already being priced into the gold price. I mean, it adds fire to the de-dollarization trade. So that it's just another reason for gold strength, and whoever we get in that Fed position is going to tend to keep rates lower for longer. So that's positive for gold. The uncertainty around the whole thing is positive for gold. So it's just another driver, really.
Question about sort of the risks that we're seeing from a macro perspective, right? In terms of macroeconomic scenarios that would lead to, severe potential gold price pullbacks. What would those be, and how are you guys thinking and evaluating those risks?
Joe, you want to take that one?
I mean, technically, just looking at the chart, we're due for a pullback, and we could pull back. We could pull all the way back to 4,000, or as Ema was talking earlier, wouldn't surprise us to have a significant pullback here. It's frankly, it's overdue. But as far as a macro scenario that would kill this gold market, it's really hard to imagine right now. To me, we're in the early to mid innings of this cycle. Of course, if Trump becomes friendlier towards everybody, is that going to happen? I mean, does anybody in their right minds think that's going to happen? I mean, we're going to have a lot of uncertainty as long as he's in office. Is our debt going away? We're still piling on more and more debt every year by the trillions, or paying over $1 trillion in interest alone. Is that going to disappear or go down anytime soon? It doesn't look like it. We're cutting taxes and spending's not going down. So, all the drivers, all the risks, it's hard to see them going away anytime soon. So I just don't see that scenario that kills this gold market.
Yeah, we have one person commenting that in the 70s and 80s we saw gold running, but then the S&P falling, then gold dropping, the S&P rising quickly. How would this time be different? I think some people are just kind of wondering that. How would the impact of strong equity markets impact the gold price?
A lot of people think that gold has an inverse correlation with equities, the S&P, and that's misunderstood. Gold has zero correlation with the stock market. That means that sometimes it correlates and sometimes it doesn't. So you can't just look at the stock market. You have to look at other things, the dollar, other risk, debt, other things that are driving gold, interest rates, real rates. Those are more important drivers than the stock market.
So I want to turn to kind of a gold, silver price outlook discussion. We've been getting a lot of questions about silver, obviously, since it's had a pretty strong run. How are you guys thinking about silver? How are you sort of assessing its fair value, and how are you thinking about that differently than valuing gold?
Yeah, we think of silver the same way we think about gold. We see it as a financial asset, as a monetary asset. It clearly has a role, and it tends to rise in tandem and trade in tandem with gold. Silver has a unique something that differentiates it from gold, which is its industrial demand component. And that's really important, especially in today's environment, because silver is part of the, I guess you could say, critical mineral story. So when we look at silver, we're always looking at how it's trading relative to gold. You look at a gold to silver ratio that went from 100 a year ago to, I guess, somewhere around 50 today. And so we were a lot more bullish gold at the beginning of last year when that ratio was at historical highs. But we're still very constructive on silver today because we do think it will trade and continue to ride gold's trade. And it beyond that, it is supported by this increasing and growing demand from electrification and from solar panels. So silver, we like silver. We think silver will continue to trade well from here, and we look for, you know, silver exposure in our portfolios to express that.
Yeah, that's exactly where I was going. Is, you know, there's a lot of miners that are specifically focused on silver. You also have, you know, companies that just have both gold and silver as part of their production profile. So just curious, you know, are you looking at specific silver miners? Are you digging into, you know, specific names, or are you really just focused on companies that have a production profile that may be more balanced in terms of its gold silver allocations?
I'll let Adam jump in here because he can explain about these silver miners. We're pretty agnostic. Obviously, we're a gold fund, so we have to have a in our strategies, active strategy has a certain allocation, but we like silver exposure just, you know, as much as we like gold exposure. It's just a little bit harder to find, and I'll let Adam speak to that.
Sure. Thanks, Ema. Yeah, look, I've been with Van Eck now for over 4 years. And when I first came to Van Eck, one of the first things that Ema and Joe asked me to do was find some silver miners to get some exposure. And it's been a challenge to find those silver miners that fit our criteria. Um, and so, you know, we do have some silver exposure, um, uh, but not as much as we would like. And part of that is because some of the silver miners that did fit our criteria have been acquired, um, and so there's fewer of them today than there were just 2 years ago, and then a large number of names that you could call a silver miner are really development plays or exploration plays that are too small and too speculative and don't make our criteria. So it's been for sure a challenge. And the traditional silver miners uh, that have been in the market for the last few decades, they've actually been diversifying into gold. So they've become less and less silver players. And then even on the royalty names, the few names that used to be royalty streamers with a silver concentration have diversified away from silver. So in aggregate, you know, our silver exposure is probably less than 10% of the portfolio, and that includes minority pieces of names that we own that are, you know, and their silver exposure. So it's below where we'd like it to be, but that's largely because of our strict criteria.
Thanks. Sorry.
Andrew, another important point on the silver market. It's at testing $100 an ounce. Certainly overbought, but the reason it's overbought is there's a genuine silver shortage globally. It started with these tariffs. Silver flooded into the U.S. Into U.S. stockpiles, anticipating the tariffs, and that silver is still there. As I saw where our U.S. stockpiles are 40% above where it was pre-Trump. And it was originally thought that there's still uncertainty around tariffs, but it's originally thought that silver would flow back to the rest of the world, but that's not happening. And the debate right now is whether these are more permanently higher silver inventories, similar to what we would have seen back during the Cold War, where the U.S. is accumulating metals, not just silver, but copper and other metals, and holding them in inventory thereby creating a shortage globally. So that's a dynamic that we haven't seen in a long time.
Thanks for bringing it back to the commodity specifically too, because I started to venture into the miners there, realizing we still have a few questions here tied to physical gold markets. Talking about how you guys think about gold prices. Are you modeling out potential gold prices? Because it seems like a lot of the estimates that we've seen from various investment banks out there have been pretty far off, to say the least. But how are you guys thinking about where gold prices could be, 2-3 years out from now?
Yeah, the consensus estimates and the analyst estimates are always chasing the gold price. I mean, nobody honestly would have predicted that gold would be almost $4,900 in January. I think I saw a lot of targets of 46 to 5,000 for 2026, and that includes us. If you would have asked me at the end of last year that gold would be at this levels today, I wouldn't have expected so. And so we're not necessarily issuing targets for the year, but yeah, 5,000 looks very achievable this year. I'm going to stress what Joe said. When something rises as fast as gold is rising this year, a pullback or a correction is obviously to be expected. So somewhere 5,000 or north of 5,000 for 2026. The analysts, like I said, will continue to chase that. So if gold gets to 5,000, then they'll forecast my increase after that, and that's reflected in the point I made earlier with the stocks, the fact that they continue to reflect a much lower gold price, because even when the analysts are calling for 5,000 this year or maybe for 2027, guess what happens to those forecasts after 2027 or forward? They drop off a cliff, and that impacts valuations clearly for the miners.
This would be a good time to move into the miners. We still have a lot of questions on physical markets, but just trying to keep with time here. We'll move on to some of the questions that we have with respects to miners and their relationship to gold. So how do you kind of expect things to go from here? We've seen these miners lag in previous periods of outperformance in gold. Is there anything that's different about this potential cycle that makes you more optimistic, that we wouldn't see strongly advancing gold prices, but maybe the miners kind of lagging due to cost inflation, et cetera?
Yeah, I think it's fair to think of years like 23 and 24, excuse me, where the gold price was rising and the miners weren't doing what they were supposed to do. 2025 was a year that it probably is what we expect for 2026. And I think the key here is when Joe talked about those drivers of the gold price, central banks and investors. Investors came to play in 2025 and are behind the strengths of the gold price in 2025. We continue, the investors, Western investors in particular, to continue to participate in the gold markets in 2026. And with that, we expect them to look not just for gold, but also gold equity exposure, which will continue to then drive the miners as a leverage play. So gold was up 60-something% in 2025. The stocks were up over 160%. You can do the math there. Do we expect that kind of leverage and beta in 2026? Yeah, I would expect a similar expression of that leverage in 26, as long as those drivers continue to be there in the form of investors. So with costs like we outlined contained, that we shouldn't see performance deteriorate from the companies on those bases, which I think it's the biggest concern in investors' mind.
I guess you kind of already touched on it, but maybe just, I mean, do you think that these miners have then already basically priced in all of this, gold price strength at this point, or is there still sort of further upside potential there? I know that you had a chart sort of outlining the potential gold scenarios, and you indicate that even in sort of a modest gold price environment, that these miners are still seeing tremendous free cash flow. Maybe you could just dig into that a little bit more, kind of give folks a recap of that, or a reframing of it.
Yeah, I think we've been talking about this for years now, how, especially last year, how the miners are not quite reflecting $4,000 gold or whatever the spot prices have been, but they've been consistently trading at a discount, whether it's 20 to 30% last year. I think it ranged between a 20 to 30% discount to the spot price. So when you ask, are these stocks reflecting current prices? Absolutely not. They're not even reflecting $4,000 gold as per our latest estimates. So at $4,900 gold, there's quite a range there and possibility for a re-rating once, like I said before, markets start to see this prices as sustainable. We get asked this a lot. Is it normal that the gold price goes up a lot before the miners get going? And yes, that's usually what happens. Markets need to be convinced that the price are here to stay. It's been quite prolonged this time, that lag, and in part I think it has to do with the fact that the performance has been so phenomenal and prices have been rising so fast that the market hasn't really had a chance to catch up.
Maybe we can just quickly touch on allocations really quickly. So you talk about gold as being a permanent part of a portfolio allocation. What percentage are you allocating to, in terms of 60-40, for example? And how should you, I guess an additional question, what we commonly get asked is sort of how should you be thinking about choosing between the bullion and the equities in terms of a breakout there?
Yeah, that's obviously a big question. How much, like Andrew said, we do think it needs to be a core part of your portfolio. We don't believe in trying to time it. Should you wait as we talk about a potential pullback? Yeah, perhaps at this very, elevated levels, there might be some opportunities in the very short term to find a better entry point. But overall, we just think if you don't have a gold allocation, you should get busy trying to build it. How much? 5% seems to be sort of the number, not just from us and our experience and sensitivities we run, but also from our broader asset allocators in the firm, who think 5% seems to be a sweet spot. What is that 5% part of? Is it your alternative bucket? Is it part of your equity bucket? That's for investors to decide. But 5% seems to do the job that investors want gold to do. How do you split that between gold and equities? I think obviously varies, but we do firmly believe that it should be a mix. Gold, it seems like a first stop, and a more natural first stop into gold investing. But for all the reasons we've outlined here and how constructive we are in the gold price and how valuations are so low, even today after 2025's performance, we do think gold equity should be part of that mix. And so a blend that amounts to about 5% of your portfolio seems to then get investors the benefits that they're looking for.
If I could add, talk about things that are different in this cycle. This is the first cycle I've been in where we're seeing commercial banks add gold to their asset allocation mix, and they added it. It's a small percentage, like Ema said, 5, max 10%. but we've never seen that before. And I think this is early days of gold again becoming, for the first time in a long time, part of a mainstream investment class. Where we have a broader audience. The gold miners had their first re-rating ever last year, positive re-rating. They've been derated for years and years. We finally got a positive re-rating last year as investors are coming into gold. So again, there's so many things that are different this time, but we think gold is entering the mainstream once again.
Thanks, and thanks again for all the questions. My goodness, we've gotten a lot of questions, and I really appreciate everybody's interest and feedback. I guess maybe just one more to before we leave it. A little bit on the juniors, because we haven't really talked much about the seniors versus the juniors. What's going on with the juniors? How are we thinking about them relative to the large cap miners as well?
I'll let Joe comment on the juniors since he's our junior specialist, but clearly we look for exposure and across the market cap spectrum, and with our expertise on the active strategy side, the juniors are kind of a sweet spot for us, and we're starting to see the outperformance that we expect from that sector. So I'll let Joe add some color to that effect.
Yeah, the juniors, I mean, we track an index internally of junior developers. These are companies that have development projects. They're drilling them out. They're doing the engineering studies, getting their permits. They're all pre-production, so they're not generating any revenue yet. But these junior developers on the index that we use internally were up 250% last year. So tremendous performance out of those companies. And this is a type of market where those companies can thrive. We're seeing at these gold prices, a lot of these projects that we were ignoring historically are coming into our investment universe. So we've got a much bigger investment universe now amongst these companies, and I think. I mean, a lot of projects make sense at these prices, so it gives us more to choose from, and a little bit of these high-flying stocks can really add to your performance.
Well, we're going to try and wrap it up soon. Any last comments that you'd like to make, Emma, here for folks?
Yeah, I think I just want to end by saying I understand and that, when you look at an asset class that had such an amazing performance, it's hard to come into the year and think about allocating or not taking some profits. But we've seen, the cycles, and we know this sector, especially when it comes to the gold mining sector, we know it very well, with decades of experience following this companies very closely. And the landscape today it's as good as we've ever seen it. Not only do we have the gold price elevated and potentially going higher to support valuations from that point of view, but we have a sector that is disciplined. It's delivering increased shareholder returns in the form of dividends and buybacks. And it's being very cautious when it comes to M&A to make sure we don't destroy value. All of the things we want to hear when we want to make an investment in equity. So independent of the gold price environment, almost at these levels, we see the gold equity universe emerging as a investable, broader market universe that we think investors overall are going to have a hard time ignoring.
Excellent. Okay, well, thank you, Emma, Joe, Adam, and to everyone who participated today. Always an insightful discussion. Hope it was for you guys as well. We also appreciate your feedback on these events too, or any questions in general. So please feel free to send along. You can reach out to us for a copy of this presentation at info@vanek.com. Just another brief opportunity to remind you guys of all the gold-related content that we have on our website, monthly commentaries, blogs, things like that, from Ema and other members of our active investment team, white papers, asset class webinars. So please feel free to check those out at vanek.com. Yeah, you can watch a replay of this webinar shortly after it's concluded. And thanks again for everyone for joining.